Lindsay, it's great to have you in the studio today. It's been a long time coming. We've had great talks about the mortgage world and financial education. I thought it'd be great. I think a lot of our audience would love to hear some of the insights you have. So thank you for joining us today.
Thank you for having me. I'm so excited to share some information.
I think it's going to be great. So you've been in the mortgage world for a while. What is, to get started, what are the biggest mistakes that you see a lot of first-time home buyers and investors do right before the mortgage is actually ready to close on?
Yeah. So it's kind of funny, but ever since I've been in the business, I have had to turn down, or I really struggle with people who just bought a car. I don't know what it is, but they go get a car and maybe they just feel confident that they got that auto loan, and then they're like, let's take the leap and go try to buy a house. But what they don't understand is that can really affect their buying power to the point where they may not be approved for anything at all, like $100,000 or something like that.
Oh, wow.
So I unfortunately have to turn down a lot of people for that reason.
For their new cars.
Yeah. So I always tell people, I'm like, buy the house first and then the car, because the car financing is so much easier than the home financing. So it's always best to get the home before you buy anything else. That way your debt to income is at its lowest. We don't have to work with a bunch of hoops that we have to jump through, things like that. So yeah, that's a big challenge that has been present ever since I've begun in this business.
So new car doesn't always equate to new house as well.
Correct.
Does it matter what size the loan is though? Like, because there are cars for $50,000 and there's cars for $20,000.
Yeah.
Does that matter?
It absolutely does. It just comes down to the monthly payment. So like if you were buying a $50,000 car, but you put $40,000 down and your loan amount is only for $10,000, your payment's going to be pretty small. So it probably won't affect things very much. But if you have a big car payment, that's going to have a big impact on your qualification.
Got it, which makes sense. Because I think the average car payment today in the U.S. is like over $800.
Yeah.
Which is crazy.
Which is a lot of house.
Insane. There's a lot of house too. Yeah.
Yeah.
that too. But even for, even for a car payment to be so high.
Yeah.
So why is it so easy to get a car loan as opposed to a house loan?
I think that it's just because it is a lot less risky. It's a lot smaller financing amount. And when you're buying a mortgage, that is the biggest loan that you can ever take out. You're being lent hundreds of thousands of dollars. And so it's much easier to finance a car than it is a house, just simply because it's less risky. And there's just a lot less regulation when it comes to auto loans. There is a ton of regulation when it comes to mortgages, and we have a lot of hoops that we have to jump through.
We're going to get into some financial education in a little bit, but it is surprising to me that some like new cars, for example, don't always, or at least my experience is they don't look for income verification. They look at your credit score, which in itself should be, from any sane person, a red flag.
Yeah.
Because they're not going to ask you to confirm how much money you make to see if you can afford this loan.
Right.
They look at your credit scores, at least whatever, 680, 720, and here's your $50,000 vehicle.
Yeah.
That doesn't make sense to me.
No, it is kind of funny.
Yeah.
And it kind of just goes back to, that's why it's easier to get an auto loan, because they're not going into your income and employment history and all that stuff.
Right.
So yeah.
And it's easier. We're not going to talk about cars the whole episode, but it is easier to get a new car with a higher price tag than it is to go through the hoops with a used car and have even lower payments. But you have all the income verification, several months of W-2s to show, and all these things. And do you think that, maybe you don't know, but is it as hard to get a home loan as it is to get a used car?
I don't know. That is one area that I wish I knew more about. And so I just know a limited amount from my experience.
Right.
So I don't know. That is a good question.
I mean, if your income is in order and you have the W-2s or whatever, 1099s for, a couple of years to prove it, as long as your ducks are in a row, buying a car shouldn't ever be an easy, because it should be a prepared purchase.
Yeah,
and that's
exactly.
kind of the things that I want to get into later is being prepared for these financial decisions that we're making, and not just, because there was a time in my life years ago that I was in the real estate business, and the subprime world was about to hit. So this is back before you were born.
Not quite.
Not quite. But we were giving the loan to income rate, debt to income ratios were over 100%, which is just insane to think about that.
Yes.
Just the rationale of giving 110% DTI.
Right.
How does that even make sense?
It doesn't.
And then subprime hit.
Yep.
So
and
it's
that's exactly why.
So and which is the writing was clearly on the wall for that one.
Yes, it was. Yeah. And then I'd say number 2 mistake that I see a lot is, because I couldn't decide on just one.
Of course.
Number 2 mistake would be not taking the pre-approval process seriously, and kind of putting the cart before the horse and going out there and shopping for homes without knowing how much you can be approved for, what the monthly payment is going to be. Can you even be approved at all? So obviously the house shopping is the most exciting part of the process, and the paperwork and the lending is not very fun.
Right.
But it's so important to do those steps up front. That way you're not setting yourself up for disappointment, or, having to backtrack and then maybe missing out on that house because you didn't do your homework up front.
Right. We know some really good agents in this space, real estate agents, but there are a lot of agents, whether that will show you the house first. Yeah. Because they want that emotional trigger to go off and well, let's just make it happen. Yeah. Let's just get it done.
We'll figure it out.
Exactly. And that is crazy. It's just not, it's not wise. It's not good, planning for your finances. And it's as if you're buying a car, because the car sales industry, that's exactly how they work. Yeah. They create that emotional bond. First thing we do is you test drive the car, and then let's go worry about your finances. Yeah. But the logical process is, let's find out if we can afford it first, and can we afford it in 6 months? Can we afford it in 3 years? Yes. That's the first step. Yeah,
absolutely.
And it's surprising how that's not, it probably is protocol, but it's surprising how a lot of agents, real estate agents, don't start there.
It is. Yeah, very.
Do you run into that a lot?
Sometimes. The agents that I typically work with are pretty good about looping in a lender as soon as possible, because it does make their job easier too. It might be obviously not as exciting or fun to start that way, but if you start off on the right foot, the process will be that much easier as it goes on, which makes their lives easier too.
Right. And you think they'd want to do it even from a sustainability point of view, because you're weeding out the ones that can't afford it. Yeah. Or the ones that you get their emotional high and then let's buy the house. And then they can't, they're denied. And then it's the agent's fault. Yeah. Which is, it's not, it's totally irrational, but it's the agent's fault. And so they're going to blame the agent. Yeah. Which doesn't make sense either. Yeah. So you'd think more agents would funnel that process, and a lot of them do. I mean, absolutely. The handful that we know is they do funnel that toward mortgage professionals like yourself. But yeah, we can't. I think when you make a purchase of this size, an emotional choice first and foremost, then there's a good chance you're going to run into some issues. Yeah, I think. Absolutely. So how long have you been in the industry?
Since I believe 2017. So about 8 years or so.
8 years. Okay. Yeah. 2017. So have you always wanted to get into the mortgage space?
Absolutely not.
Sounds familiar with a lot of people. Yeah. So how did that come to be?
Yeah. So I knew that I wanted, or I knew that I liked finance from a pretty young age. My parents really kind of modeled that importance to me, but I didn't really want to do it as a career necessarily. And I went to college, and I did not start in finance. I started in architecture, actually. And I very quickly realized that wasn't my jam. So I just kind of defaulted to business, because you can't really go wrong there. No. Finished it out, and I was looking at jobs, and actually I would see all these loan officer jobs online all the time, and I was like, no way, absolutely not. So I just did kind of some random entry-level jobs. And then there was a point where I was recommended for a loan officer assistant job to a mortgage lender, and I took it. I was in need of employment at the time. And I dove in. I really liked it, actually. It was nothing that I expected at all. It was very dynamic, a lot going on. I really liked how we get to work with a lot of different people and a lot of different scenarios and things like that. So I stuck with it. I was offered a loan officer job probably about 9 months later or so. And it's just stuck ever since. So.
All right.
Yeah.
So did you have a finance minor? Because you were a business major. So you'd have
my area of focus was finance.
Finance.
Yeah.
Does that help you today in understanding these insurance or mortgage products?
Yeah. In a way, I think it helps me problem solve and kind of figure out solutions for people because I do kind of have that background. They really didn't touch on mortgages though in school. Like all of that education was learned on the job and through like continuing ed and just learning from colleagues and things like that and just really doing research and learning as I go. But as the finance industry as a whole and just kind of what it all entails, I did learn quite a lot in school.
You said that growing up, your parents, taught you a lot about financial education. How much did that play a role in your even decision to switch into business?
Quite a lot. Yeah. They really emphasized, very strict financial, or I guess they demonstrated really good financial practices growing up. And it just kind of, ever since, gosh, I don't even know how old I was when I opened my first investment account, but I was pretty young. And my dad always kind of looped me into that and just kind of showed me like what he was doing and looped me into the meetings with our financial advisors and things like that. So I kind of always had that background. So, and it was interesting to me. So I thought, and the world of business is so vast, like you can really take it and run with it wherever you please. So just kind of that background, I think, was what led me to that decision. I just knew that it was interesting to me and it was something that I wouldn't be like stuck on one path with. I could really do whatever I wanted with it.
Do you think that some of these principles that you grew up with, financial education, you're able to transpose into the mortgage world today, or are your clients, are they open to constructive criticism or planning strategies, things like that?
I think it's more like people come to me in a pickle or in a situation where they need help. And I kind of, based on my experiences, can help them and can really just make suggestions to them that are helpful to get them where they need to be. Because obviously, if I didn't know what I was doing, I would be of no help to them. But I kind of have figured some things out over time, and I've had great models in my parents that know what they're doing and have demonstrated that to me. So I can demonstrate that to my clients pretty well, I feel.
Yeah, it's important. I think it's important to lead by example, first of all, but also to have clients that are willing to learn and to grow as well, because it's an education process. It's a journey as well.
It is
not, you buy a house and you're done. You got to continue to maintain that mortgage and afford that mortgage.
Yeah. And it's really unfortunate because so few people were as lucky as I was. And so they truly just don't know. Yeah. So having someone that can sit down and say, you can't rack your credit card up because that does have an impact to your credit score. Some people don't know that.
Right.
Or like how big of an impact a missed payment has on credit and things like that. How do you know that if someone didn't tell you before? So.
Exactly. No, it's true. You don't, what they say, you don't know what you don't know.
Exactly.
But it's true. I think in high school back in the day, we used to have these classes where we learn how to write checks and things like that. But that was the extent of it. So I've always known how to write a check because of my high school days. But you're right. We didn't have true financial or credits education at all.
Right.
And you didn't know that. And there's a lot of misinformation out there. There's, do you have to pay off that entire loan every month, or does your credit help to have a little bit riding on it every month? I mean, a lot of things like that. People don't realize, the impacts of missing a payment or the impacts of maxing out your credit card. They don't get it. Or when they're, when it's full, when the credit card is full, they move on to another one.
Yeah.
These have dramatic impacts on the ability to purchase, for sure.
And people just don't know sometimes.
Yeah. Do you think that, like, first-time home buyers, if we talk about them for a while, do you think that a lot of buyers get lost in the weeds of what they have to get ready for? Or
Absolutely.
What's essential in getting ready?
I think it's a very daunting process, and I think that people have these misconceptions out there because they've heard a lot of horror stories, I guess, and people are just truthfully scared of making a mistake. So they do a lot of research, which is good. It can be good, but like you said, there is misinformation out there, and I think a lot of times if you do too much research, it can almost scare you into not buying or making mistakes and things like that. So I just suggest for first-time home buyers finding a loan officer and a real estate agent that you really trust and just follow their guidance. Just lean into them and their knowledge. And, the research is good because it allows you, it makes you think about questions to ask, which is great. But honestly, don't do too much because we are the people that do this every single day. We see all types of borrowers, all types of situations. And those are the people that you really just need to lean on and follow their guidance. And again, just finding someone that you can trust and lean into is important.
So you do have real estate agents that you recommend to people if people ask you?
Yeah. So absolutely.
Are there misconceptions for first-time home buyers, or they think this is true, or think this is like in terms of down payment assistance and things like that? Yeah,
there's a lot. There's misconceptions on both ends of the spectrum. There's the people that still think you need 20% down and, a 700 plus credit score. And then there's the people that, are kind of almost entitled to a mortgage that don't have a great credit score. And they're surprised when they can't get approved, or maybe they don't have a great credit history or employment history and things like that. So there is a lot of misconceptions on both ends of the spectrum.
Right. And so, because financial literacy seems to be a gap in what people should know and what they don't know. And you help them walk through that process?
Yeah, absolutely. I really like the first-time home buyer courses that are out there.
Okay.
Some loan programs require those courses before you can close. And it's not, they apply as they're a requirement for some loan programs, but anyone can take them. Even if you're getting, a conventional loan that doesn't require a first-time home buyer education, you can still take it if you're curious. And I think that there's a lot of information in those courses that even I can't dive into. And like the WCDA first-time home buyer course has a one-on-one counseling session with Wyoming Housing Network that's required. And they go in and they sit down and make a budget and they talk about the loan process, and they make sure that they're really prepared, and they really take a deep dive into that. So I love that. I think that that's super important. I can only do so much, but that is a component where we kind of start with what are you comfortable with for a monthly payment, and kind of build your loan around that.
So what are these basics? Like if someone wants to sit down with you, and what do you go over in terms of how much they have in the bank as a down payment? What are those basics?
Yeah, so the basics that I start with are really just the information for the application, because that just gives me everything I need to know to build a loan around them. So like employment and income history, asset information, so account balances, credit score. But the one thing that I find most helpful in kind of matching someone with a loan is I ask them, what are you comfortable with for a monthly mortgage payment? Or do you have a maximum amount that you don't want to exceed? I ask every single person that question because it gives me a place to start, and I kind of get an idea of what they're shooting for, what they're comfortable with. And I feel as long as we don't veer too far off that number, they're going to be successful with their mortgage.
Okay. So they need to come with an idea of what they can afford per month.
Yeah.
And then they have to be able to prove that or justify that with income and say, this is how much we make. If we make $1,000 a month and they want a $700 mortgage,
that's not realistic. Yeah, exactly. Right. So there is the component of what are you comfortable with, but then also what do you qualify for? Right. And a lot of times people are more comfortable than they can qualify for, or the opposite. They qualify for a lot, but they're only comfortable with X amount of dollars per month on their mortgage. So that to me is really important, not, saying, oh, you're approved for X amount, that's where you need to be shopping. Well, that might not be in their best interest. So it's important to know where they're comfortable with.
So what are the current guidelines? Is it flexible in terms of debt to income ratios? Or are you advising a certain percentage? Where are we at?
It's really dependent on the borrower. A lot of people they're really savvy with their budgets, and they know exactly how much their mortgage payment is that they can afford, and they know that dollar amount, and we can do that. Other people mismanage money. So it could be a much smaller percentage of their income where they need to be for a mortgage payment. I think, like the Dave Ramsey rule, if you will, is somewhere in like the 20%.
Interesting.
For debt to income purposes for the mortgage, we're more interested in the total debt to income. So the mortgage payment, any auto loans, student loans, credit card payments, all of it combined is generally a maximum of 45 to 50% of their total gross monthly income.
Right.
That's
Which
the general
seems like
rule.
A lot, to be honest. 40 to 50 seems a lot.
Yeah. I think it also depends on the borrower and what their income level is. Sometimes you really, especially with where income versus price of home is at these days, a lot of people are stretching that. But that just means that they have to cut back on other discretionary things. Right. Whereas someone with a higher income may be able to stick more comfortably in like the 30% range or so. Right. So it just depends on the borrower and their income levels and what price range they need for their house.
So if the average mortgage is $2,500, would you say that's average or?
Yeah, I think that's a good amount.
So it means that the household income needs to be more than $11,000, $12,000.
Yeah, roughly.
Yeah. So.
And I mean, that's just for, being comfortable. You can stretch that up to like, if you don't have any debt at all, maybe you can have a closer ratio to like 45% or so. I think it's like 43 for just the housing portion.
Got it. So it's a case-by-case scenario, but it's about having that conversation is like, can we afford this in 6 months, in a year, 30 years down the road? Are we going to be able to afford these payments?
Absolutely. I think there's always two components to it. There's what you qualify for and what you're comfortable with. And I think the most important thing is what you're comfortable with, and just knowing your spending. And another thing that I like to ask too is, what are you currently paying for housing, and are you comfortable with that amount? A lot of people are renting, and then they buy their first home, and that's really a good judge of where you need to be with your payment. If you're comfortable with that $2,000 a month rent, maybe the mortgage needs to equal about $2,000 a month.
Right. So, but those are difficult conversations to have because not everyone has a household income of $10,000 or $12,000.
Yeah.
And if so that boils down to having a larger down payment. Things like that.
The larger down payment, I don't know. I'd say that's kind of another misconception because people think that having a larger down payment is going to significantly decrease their monthly payment. And even if you have, $20,000 extra, it's probably only going to decrease your payment by $100 or so a month, which isn't a ton. So it's easier to look at, in my opinion, paying off a loan, allocating that money towards paying off a higher interest loan with a shorter term. That way it frees up, maybe a few $100s with that $10,000 or $20,000, rather than just applying it all towards the mortgage and just getting $100 decrease or so.
Right. Yeah. And also it seems like people are sometimes in a hurry because it goes back to that emotional connection. They want to buy the house now, but it sounds like what you're saying is that they have an extra 20,000 in savings or even 10,000 in savings. It could be better to apply that to a credit card and then wait 2 or 3 months and also benefit from a bump in your credit score.
Yeah. Absolutely.
Because it takes a few cycles before your credit score will be affected as well. And so if you get an extra, if you push, over 700 and you're at 680, that could change your interest rate as well.
Yeah.
Correct me if I'm wrong.
That's true. Especially with conventional loans, conventionals are going to be pretty susceptible to the credit score. FHA, maybe not so much. But in some instances, you will see a difference in the interest rate and mortgage insurance rate with a 20-point increase or so.
Thanks for watching today. These podcasts are powered by PayRock, and PayRock is a payment solutions provider. We work with any size business or nonprofit, improving those payment acceptance efficiencies while reducing those overall costs. You can get a hold of me through any one of those social media channels, or you can give me a call. Let's get back to that podcast. What do you recommend for like down payments? Like, is there a percentage that they should be ready for?
I always say at least a couple $1,000s to have in your account, because you can do a down payment assistance loan and pay as little as $0, or like you need to have money for earnest money and inspections and some funds after the fact. But so you can have as little as $0 to close, or like an FHA loan is 3.5%, or a conventional loan is 5% down. So anywhere from, I say, a couple thousand to 5% down.
5% or whatever the purchase price is. So, but it goes back to having a conversation, because knowing with your income what that equates to in a mortgage is not sometimes easy math for people.
Yes. So, exactly.
If someone comes to you with less than perfect credit scores, what kind of advice can you give them?
I always like to pull a credit report just to see where they're at, because there's lots of reasons for someone having less than perfect credit. It could be that their credit cards are simply maxed out, or maybe they have some collections, or maybe they only have one account open, but you had a missed payment 6 months ago, which really impacts credit. So it's a very case-by-case basis. And I pull a report and we kind of go through it, and I just point out some things that is helpful to that individual. It's never a one answer fits all. Sometimes it's even a matter of opening a new account where maybe all that's reporting is collections. They don't have any open accounts in good standing. So it's a very case-by-case basis, and there's a lot of different reasons for people to have low credit scores.
When people come to you and they talk about the monthly payment, because that seems to be like a selling point for a lot of, going back to used cars or cars. It's like, what payment can you afford? Yeah. But there's a bigger picture involved. What kind of education would you provide someone that's just merely focused on, fitting this into their monthly budget? Is there more things that you talk to them about?
I think just relating it to what they're currently paying and what their comfort level is with that. As long as they know for certain what their monthly payment comfort level is, we can really just build everything around that. I don't like when people necessarily come to me with, I want to buy a house for X amount, because you don't know what that payment's going to be. Right. You can, calculate it yourself and kind of get fairly close. But to me, they need to know what the payment is and what they're comfortable with. And so if they simply don't know, again, I just relate it back to, what are you paying now? Are you comfortable with that? Are you saving in addition to your rent payment? If you aren't, maybe we need to stick closer to that current amount that you're paying. If you are, maybe you have some room to bump up your future mortgage payment. And again, another thing that I find really helpful for someone that knows that they want to purchase in the near future is what I can't remember where I heard this term, but it's called practicing your mortgage payment, where say you currently pay $1,000 and you want a home that's going to cost you $2,000, pay your $1,000 rent and then put your $1,000 difference from the $2,000 total in a savings account. After you demonstrate to yourself that you can do that repeatedly on a monthly basis for a while, then you know that you're ready and you'll have some savings set aside. So I think that can be so beneficial to so many people if they just kind of took the time to do that. And that way they know that they're going to be okay with that payment. And you have the demonstrated savings too, which is always helpful when it comes to the approval process.
So putting in $1,000 in another account on the 6th and then withdrawing it on the 7th, does that count?
No. Good idea though.
What about real estate investors? Is that a whole nother world? Do they get ready differently? What's different?
I wouldn't say they get ready differently, but their objectives are definitely different. They are generally more savvy. They have some money saved up. They generally have better credit. Things like that. So it's more of a process of, here are the loan types that are available to you. What are your objectives? Versus maybe with a first-time home buyer, it's just a conversation of, okay, how do we get you to qualify at all? Mm-hmm. So it is a very different approach.
Is a loan different in itself? Is it different?
Mm-hmm.
Is it a specific type of loan for investors?
There are specific investor loans, I generally advocate for a conventional loan if you can on an investment property. The occupancy and the terms are just different.
Okay.
So an investment conventional loan is going to have a higher interest rate as well as a higher down payment requirement. But it's still going to be, you're still going to have the option of a 30-year fixed loan. A lot of times it will be better terms than a true investor loan. So that's always the first stop because I think that that's the best option in most cases. If you don't qualify for that, then there are many other different options out there where a DSCR loan, debt service coverage ratio loan, that's a true investment loan, or there's commercial financing or hard money loans or private loans. So there are a lot of options out there.
How is the DSCR loan? How does that work?
So it is a no income loan. So the income, if you will, is determined by the anticipated rent of the property that it will produce. And generally speaking, as long as the rent that the property is expected to produce is higher than the monthly mortgage payment, you qualify. You just still have to have a sufficient credit score and enough assets for the down payment. But the income portion is based on the actual property rather than the borrower.
So if they have 105% income projected, then they can get the loan.
Generally, sometimes that percentage ranges. Sometimes they can go as low as 75%. Some have a maximum amount of 125%, or a minimum of 125%. And it really just depends on different factors of the loan. Like if your credit score is lower, they may require you to have 125%. If you're only putting 20% down, you may be required to have 125%. It just kind of depends on those factors. But
so the loan can be approved, but you still need a down payment.
Correct.
And it's 20%. Roughly 20.
Minimum 20%.
Minimum.
Sometimes 25. Again, It depends on credit and all those fun factors. A million different factors.
Got it. Can you, because I know there's strategies with, for home buyers, like residential, 100% occupancy, owner occupancy loans, where you can get the seller to pay for your closing costs, or can the seller pay for down payments?
No. Sellers can't contribute towards down payments, but they can contribute towards closing costs. So closing costs can be anywhere from lender fees, title fees, prepaids, escrow items, discount fees, anything like that. And it's usually capped at a percentage depending on loan type. Typically 3% for conventional and 6% for FHA.
And does that work the same for the
DSCR?
Yeah.
That's a good question. I don't know off the top
You
of my
don't
head.
know.
I know. Sometimes I have to look things up.
Right. So there's also the strategy of getting the seller to pay your points or paying down your interest rate.
Yeah, buy downs.
Yes. So how does that work?
So there's two types. There is a temporary buy down where your interest rate is lowered by either 1%, 2%, or 3% for the first year, and then it can be a 3-year maximum. So if you do a 3-2-1, it's 3% rate reduction for the first year, 2% rate reduction for the second year, 1% rate reduction for the third year, and then your regular rate thereafter, or a 2-1 or a 1-0. And that is funded 100% by the seller. Sometimes lenders can contribute as well. We offer a 1-0 buy down to our clients, but typically it's funded by the seller. The other option is a permanent buy down. So it is, it can really be any amount within reason. It still has to fall within those 3 to 6% ranges. But it is a permanent reduction in your interest rate. So say the par rate is 7%. The seller can contribute, say, $10,000 and get you to a 6.5%. That's for the lifetime of the loan. So the temporary is good because it kind of gets you more bang for your buck in the short term. The permanent is good because your rate is a reduced rate for the lifetime.
So is it roughly $20,000 per point? Because you said 100 for a point.
That was just
or 10,000.
Yeah.
Yeah.
It's a percentage of the loan amount. So a larger loan amount is going to cost more. Your $10,000 might only get you 0.25%. Whereas if you contribute $10,000 on a $100,000 loan, it might get you a full percent.
Okay. And there's a maximum of 3% you can take down?
Paid by the seller, yes.
Right.
Yeah. The permanent buy downs can actually be paid by the borrower too. So you could do a combination of maybe a seller credit and your own funds.
Got it. So you can do both.
Yep.
So, but it doesn't increase the loan value. It just because the seller's actually paying
closing cost.
Right.
Yep.
So the seller's paying that out of his proceeds.
Correct. Yep.
So is that one of the better strategies out there to get a better, better loan?
Yeah. I guess when you are comparing, like, if you don't qualify for any of the lower interest loans, like a first-time home buyer loan, like I mentioned, the WCDA loan has a pretty low interest rate, but it's also got a low income limit. The only other way to lower your interest rate is by a buy down of some form.
Mm-hmm. If on a DSCR loan, if you go higher than 125%, does that down payment percentage decrease?
It could. Mm-hmm. The requirements are tiered. So it is what we call a non-QM loan, a non-qualified mortgage. So the investor really sets their own requirements. So a lot of times that's why you see those different tiers, is because that investor is making their own requirements. So it is entirely possible that there are investors out there that if the property cash flows more, they might not require as much down
payment. Got it. Okay.
But at minimum, no matter what, it's going to be 20%.
20%.
Yeah.
Got it. And can you get a secondary loan to cover that down payment?
I don't believe so. I think it needs to be a combined loan to value of 80%.
Got it.
Yeah.
But even like a hard money lending?
No.
No.
You could season the funds.
Okay, so you have to have 20%.
Yeah.
Got it.
There are strategies out there that I won't speak to, but
okay, off the record.
Yeah, off the record.
Are there any other financial strategies that you advise investors on when they want to maximize their portfolio and returns on their investment?
Yeah. I think, let's see, if you are just starting out, you can actually buy an investment property, if you will, as a primary residence. Mm-hmm. So you can buy a home with a conventional loan or even an FHA loan with 3.5% to 5% down, live in it, and then later on rent it out. It's a really great way to get a good interest rate and purchase a home with less down. Mm-hmm. you can still have the intention of renting it out later on, just as long as you do live in it for generally a year.
Okay.
And you can do that repeatedly. You can only have one FHA loan at a time, so you could only do the FHA once. But you could buy a home with a conventional loan and then move on to another conventional loan, and you can kind of acquire properties that way. So I think that obviously people with their families may not want to do that because it is a lot of work moving around, and generally investment properties are kind of on the lower price range, so it might not be a home that you want to live in per se for a long term. But it is a really great way to be able to get some properties under your belt for low rates and low down payment.
There's that 12-month owner occupancy.
Yep. Mm-hmm.
Got it. So you can do a no money would that be FHA?
Yep.
Zero down?
Yep.
And then after 12 months, get into a conventional.
Yep.
And you can maybe take a line of credit off the current house.
Yeah.
If there's equity.
Yeah.
As your down payment.
Absolutely. Yeah. There's different ways that you can kind of go about it, especially once you have a few under your belt.
Right.
And you've built up some equity and things like that. Another thing too is just knowing what type of investing you want to do. Whether you're going to do like a fix and flip loan, maybe a traditional conventional loan isn't so great for that. Maybe like private financing or hard money loans are better for that. Or if you're just doing like where you want to have rentals, then traditional financing or like the DSCR loan is a good option. So it just depends on what type you're doing as well.
Got it. How are the income? You said projected income for investment properties. So if there's 125%, minimum,
how do you come up with that number? Good question.
Yeah.
The appraisal. So the appraisal will give us the value of the home, which it has to meet the value, obviously. But it also, we order a rent schedule, and the rent schedule tells us the approximate amount that the property could rent for based on the current market. So the appraiser actually does their research to see what similar properties are renting for currently.
Got it.
And then calculates a number.
So there's a structure. There's already a framework in place.
Yep.
So you can't use other strategies or to increase that income potential. It's capped.
Yeah, typically. There may be a way out there to use like a current, like if the property is currently rented, sometimes they allow you to use that amount. But traditionally we order the appraisal with a rent schedule. Okay.
All right. So is that information available online? Is it
no
region, or we got to go to you?
Yeah.
Which is not a big deal.
Yeah. And then the thing that's kind of complicated about them is there are so many investors out there that, and again, they all make their own rules. So you kind of just have to reach out to the investors to see which one is going to be the best fit for the given scenario.
So when you talk about investors out there, you're talking about the money lenders.
Yeah.
So there's investors investing in an investment property with another investor.
Yeah. So they're called brokers. And they are basically companies that just do specialty type loans. Your traditional financing is generally like conventional FHA, USDA, VA. Those are all sold on the secondary market to generally Fannie, Freddie, or Ginnie Mae. The non-QM loans that are done with brokers are held with them. They're not sold on the secondary market.
So they're private investment companies.
Yeah.
BlackRock and all those companies.
Probably.
Which you probably don't do a lot of loans with BlackRock.
No, I mean, maybe, I don't know.
So there's probably different layers to these larger companies.
Yep.
Anyway, so when you speak about these brokers that are are there just like private companies or private investors, or are there local investors that are lending money to other investors?
There probably are some like private investors out there. The companies that I work with are not local. They're I don't even know where they are at.
Got it.
But they are not here in Casper, Wyoming.
You're also really big on financial literacy and helping people walk through the process. Are there certain things you want to walk them through in terms of savings and budgeting and potentially investments until they make that deep dive into either a first-time home purchase or even investing? Is that what do you usually talk about?
Probably just, again, the monthly payment and what you're paying now versus what you're comfortable with. Making sure, if they are consistently late on their rent or making their regular payments on their credit that they currently have, that is probably a good sign that they're not ready to buy. And maybe that comes back to the practicing your mortgage payment idea, where you maybe need to take a step back and get to a spot where you're comfortable with your payment and have a little bit of extra funds left over each month. Because it is important to have that savings once you're a homeowner. Like once you close, it's really just the beginning. There's still, home ownership comes with a lot of responsibility. There's going to be things that break and you're going to have to fix them, and you're going to need a plumber from time to time or things like that. So it's important to not only be able to get yourself to a point where you can close, but you also have some savings in case something like that comes up.
A rainy day.
Yeah, absolutely.
Yeah. Or a HVAC system that falls apart, or in the middle of winter or the middle of the summer for your air conditioning.
And those aren't cheap.
They're not. It's not like replacing when you're renting. You have to replace, a spatula that breaks.
Yeah, exactly.
Not the same expense.
Yeah.
A lot of people don't realize the value of taking care of their credit score. How do you convey to them different strategies? What do you convey to them, and how do you convey in a way that actually sticks and they realize, I got to take care of this thing?
Yeah. I think giving someone a goal is, a really good first step. Once you tell them, hey, you need X score and you are at, 550 or whatever, that really kind of kickstarts things for them. It gives them a goal. It gives them something to work towards. And we have a really cool tool that we use called Credit Expert that it's basically a credit simulation tool where it analyzes the credit report and basically predicts if you do X, Y, and Z, your score will be 620. So I use that tool a lot, and it breaks down exactly what they need to do. So having a really clear path forward is really helpful to a lot of people. That way they're not just shooting darts in the dark and they're just trying things that may or may not help. Or maybe they're even, they think that they need to pay their credit card down to $0, but actually they only need to pay it to $200. That way they're not spending that extra $200 that could be allocated towards the purchase or even savings that's unnecessary.
What are the minimums? I mean, like you can't help someone below this credit score.
There's really no hard set minimum, I'd say. Generally, I say 620. However, an FHA loan will go down to a very low score in the 500s if you have enough down.
Oh, wow.
Most people with a credit score in the 500s doesn't have a significant down payment, so we don't see that very often. So for your average borrower, I would say 600 to 620 is probably a safe minimum.
Got it. At the same time, if they come and see you today and they do have a 500 or a 520 credit score, you can put them on a track to get that up to a 620 and get something done.
Yes, absolutely.
And it goes back to being ready, I think, because their interest rates over 30 years will be significantly lower if their credit score was lower. So, rushing into anything is never a positive thing.
Yeah.
The deal of a lifetime, if you can't afford it, is not the deal of a lifetime.
True. Yes, absolutely. It can ruin you.
Yeah. What's the biggest mistake, like in financial literacy, that you see that people are not understanding about the mortgage space?
Probably the savings piece. It is really important to have that cushion, if you will, and just living below your means, even by just a little bit. Yeah. Even if you can just save, $100, $200 a month, it's going to set you up greatly in the future. That way you're not going to have all these little collections piling in that are
letters in the mail. It's your final notice.
Yeah, exactly. And then also kind of understanding the importance of a mortgage and how many regulations are actually out there. Like I mentioned previously, I think there are still a lot of people that do feel entitled to a mortgage. And there are, don't get me wrong, there are a lot of people that are deserving of a mortgage that don't exactly fit the weird little box. But then there are also people that, you know, come and they don't have a demonstrated employment history. They job hop with gaps and their credit is bad and things like that. And we're lending hundreds of thousands of dollars out to you. So you have to have that demonstrated proof that you have the income, you will have the income, you can repay it. Someone that's, you know, consistently missing their $25 credit card payment isn't a good candidate for a mortgage. We do have strict regulations that we have to follow. So, and a lot of times I think people just simply don't understand all of the criteria that has to be met for a mortgage approval.
Right. I think financial education is extremely specific because I was speaking to someone recently, well, about a year ago, and extremely educated person, very smart, you know, and working in a field where, you know, knowledge is super important. But this person didn't realize that the credit card that he obtained 3 years ago that had a, you know, introductory rate of, I think, 0%.
Zero, probably. Yeah.
0% on the Discover card doesn't maintain through the life of the ownership of that card. And so he was saying that, you know, I got a good rate on my card. I can put everything on this card, and it doesn't work like that. And so it's financial education. You can't just say that people are, you know, they're ignorant in the true sense of they don't understand how financial, financial, you know, tools actually work.
Totally. Yeah. It's actually funny you mentioned that because I went to my doctor last week and, you know, he was talking about, you know, he could never do what I do. And obviously I could never do what he does because it's just, you're so good at your profession, but then and you can be so intelligent, but there's still all those things out there, those fine little details that you just don't know, no matter how intelligent you are. So yeah, we both had a laugh about that.
Yeah, because financial education is very specific.
Yeah,
and I think the lesson that I bring home is the fact that it's important to talk to someone that knows what they're doing and has the experience, but also the knowledge to walk you through something. And it's not a sign of weakness to go and talk to a mortgage person a year or 2 years before you actually purchase. I think it's extremely wise.
I think so too.
These purchases.
Yeah, and I think a lot of people just put it off because they're scared. But it's really the best thing you can do is, even if you're not quite ready, to just take that leap and do an application. I mean, what's the worst that could happen? You know, I'm not going to tell you no. I never tell anyone no. I just say, this is what you need to do. And that way, you know, once that perfect house pops up, you know that you're ready and you know that you can put in an offer.
Exactly.
So yeah, I wish that people wouldn't be so scared or intimidated by it, because we're just here to help and educate.
For sure.
And get people, you know, where they want to be.
Right. Because on one hand, it's true that in today's market, because it is a seller's market, you have to be ready. So if you're wanting to buy a house in the next 2, 3, 6 months, or whatever, you better get ready. And if you're planning on buying a house in a year or 2 years or 3 years, it's better to reach out to Lindsay, your preferred mortgage consultant, but Lindsay is
preferably me.
But to reach out now and not wait.
Yeah.
You know, because it does take time to get ready. And I think you know, what we don't learn at home, we'll never learn unless we're willing to sit down with someone and try to learn something. That's why we have coaches. We have a coach for the gym. We have a coach now we have life coaches. I think that having a coach for financial education is not something that's out of the picture.
Exactly.
Because we have to learn these things. And if we see the not to get political, but when we see the government, you know, live on, you know, they make less borrowed funds, and we have, you know, a national debt of trillions and trillions of dollars, that it's only normal. We can't expect the households in America to not do the same. And so the average debt, I don't know what the average debt is in America yet. I think it's in the $70,000 $70,000 of just household debt for credit cards. So it's, and I don't even think that actually considers cars or homes.
Yeah, I don't know. That's a good question.
I think it's credit cards.
It probably
just
is.
Pure credit cards, which is astronomical.
Yeah.
But what we see we emulate, and what we grow up with. If we don't have that financial education when we're children, we're going to replay that over and over again.
Absolutely. Yeah.
What are some of those things, if you don't mind sharing, that you did learn when growing up, like percentages and savings or investing, things like that?
I wouldn't necessarily say there were any like hard set rules. It was just, you don't spend everything that you make. It was kind of funny because I would get birthday money and my dad would make me save half of it. And so my aunt would like give me money secretly and be like, you can go spend this. But
the truth comes out of your aunt.
Shh, don't tell her. But no, I think it was just a matter of don't spend everything you make. And if you can't afford it, don't buy it. And so that just kind of, I got my first job in high school and it was so exciting because, I'd get few $100s every couple of weeks. And, I'd definitely go spend some things, buy some things, spend some money, but I also saved some too. So, and that gave me a lot of satisfaction, to work for something and get to go buy something of my own at my own discretion and then still have some left over. And then ultimately, like that savings helped me buy my first investment property when I was pretty young. I can't remember how old I was, but if I wouldn't have done that, I wouldn't be where I am today. So also I think learning that very early on in life really set me up for success. It's never too late, they say, to start investing or start saving, which is absolutely true. But the sooner that you can do it, you're really going to set yourself up for a lot of future success.
So are you still saving 50% of your income?
Oh, I should be.
I wish you were.
I have bills now.
Right, exactly. You have a life. You're adulting.
Yeah, my parents aren't footing the bill anymore.
Right. Yeah. When you live at home, it's much different. Yeah. Much different. What about adjustable rate mortgages? Because they look appealing. Or there's there's other loans where you're just paying interest, but you're not. What are those called?
So the loans where you're just paying interest is a line of credit.
Okay.
And then the adjustable rate mortgages or ARMs is where you are paying down the principal, but the interest rate changes every so often depending on the terms of the loan. And they can be appealing with a lower rate sometimes. And even a line of credit or an ARM has a specific borrower that they can help, that they are good for. An ARM might be good for someone that is only going to be in a home for a certain period of time, and they know that. And that is great because they're going to move out prior to when that rate is going to adjust. Other times it's just a matter of knowing that you'll probably have to refinance it later and making sure that you will be in the position to qualify again. And then a line of credit is great for someone that just needs temporary money. And because they're generally pretty easy to get, it's a pretty quick process. You don't have to refinance your whole mortgage to utilize those funds, things like that. But it might not be a great long-term solution unless you do plan to make more than the minimum payment because you're never going to pay down that principal balance. Yeah.
So it's called a line of credit, even though it's specifically in a mortgage context.
There's different lines of credits that you can get. A home equity line of credit is kind of what I'm referring to. Yeah.
The HELOC.
HELOC, yep.
There's a HELOC and there's another type of home equity.
A HE loan?
HE loan, yeah. What's the difference? Yeah.
So the HE loan is an amortized loan. So it does pay down principal over time, and it's for a set period of time that you pay down.
So the HELOC is just interest?
Correct, yep.
Oh, wow. Okay, so that's another reason why you need a financial advisor.
We know all the terminology.
There's some mortgage companies, most of them are online, that are promising these great deals. How do you educate your buyers or your investors that not everything that looks good is good? Yeah. And it's maybe if it's too good to be true, it probably is too good to be true.
Yeah, that's a good question. I think it kind of speaks for itself. Those online lenders are just that. they are online. They may pick up the phone when you need them. They're not going to problem solve for you. They are order takers. If you have a great loan and you're an easy borrower and there's no weirdness, it might turn out okay.
Got it.
But someone that needs some help and some guidance and wants to compare different products, you're not going to get that service from those online lenders. And it's, you can call me anytime and I'll answer the phone. You can come in and meet with me face to face and we can go through products and I'll ask you, you can ask me questions and things like that.
Yeah.
You can't do that with an online lender. So I think that that's really important. And also, they generally don't have as many product offerings as someone local or in person would. They don't have all of the Wyoming state products. So the only way you're going to get those is if you come to us directly in person locally. So I think the biggest thing to me is they're not going to problem solve for you, and they may not, probably not, don't have your best interests at heart. This is my business and I have a reputation, and I don't want to give someone a bad experience and have them go tell all their friends.
Right.
And because I'll get a bad reputation over time. The online lender, that doesn't matter to them. So I think that there's kind of a higher standard for us local lenders than the online lenders. And that's who you want to do business with, is someone that you know is going to do a good job for you because it matters to them.
It does, absolutely. And I think that's what sets people apart from selling a commission. They're out there just to make their commission.
Yeah.
And agents are the same way. A lot of agents are just selling their commission. They're not selling the future home where memories are being made inside this home for your family. They're like, how much, what's my percentage off of, $30,000 or $300,000. So, and that's very true. I asked you for an estimate on a house. What do we call those things?
Cost estimate?
Cost estimate. And I forgot you were on vacation. You were in Texas. And, And then I emailed you, and you within a few hours, you got it to me. So it's like, that's the kind of service. If you're calling on a Friday night to Rocket Mortgage or whatever, they're probably not going to get back with you until.
Yeah, they're not.
Yeah.
And I that's always really important to me, because when your deal is going south or you just got bad news about something, that's all you're going to think about. And I don't want someone, going into the weekend with that hanging over their head like that. There are instances where, I need help from underwriting or someone else and I'm at their mercy. But for the most part, it is important to me to get someone a solution as soon as possible, or even when they're writing an offer. It's good for them to go into that confident, knowing how much their payment's going to be and how much they are going to need for down payment or closing costs. So, and a lot of times that happens on the weekend. So it's, I understand that, and I do my best to make sure that I am accommodating to that.
So people that are listening, if they feel like their mortgage advisor is just selling their commission, they should reach out to you.
Absolutely.
And get a second opinion.
Absolutely.
Or if they're feeling the same thing for their agent, their real estate agent, you have some options. We know people that aren't like that. They truly want to help.
Absolutely.
But not all agents are made the same.
They aren't.
No,
nope.
Not all mortgage.
Unfortunately.
If you could change one thing as we wrap this up, because it's been super interesting, but if you could change one thing about the mortgage industry, what would you change?
Probably the hyper focus on interest rates and home prices. I think, as I've said multiple times, it's really just about the monthly payment. And if you're good with that payment, why does the interest rate matter? If we can accommodate that monthly payment and match it with a home that you love, that's really all that matters. And I think people are so fearful right now of interest rates and home prices that they're sitting back and they're wasting appreciation that they could be gaining. They're not making a payment to a mortgage where they could be paying down the principal balance already.
Right.
So they're really just sitting there doing nothing in fear when they could be gaining. And interest rates really aren't that high. They are high compared to a few years ago, but historically speaking, they're not so terrible that you should be frozen and not taking action and buying a home.
Yeah, we're short-term minded. If we
Exactly.
look at, over the last 10, 15, 20 years, we'd have a different perspective. So last question is, for people that are considering buying in the next, 6 months, a year, what's one piece of advice that they could work on between now and the time they call you?
I would say keeping credit card balances low or paying it down, because I think that most people don't understand the impact that paying your credit card balance down does. Oh, yeah. Even if you're making your payment on time each month, having a higher balance close to the limit is going to have an impact on credit. It could be a difference of 50 points or something just by simply paying it down just a little bit. So, and I think that that's probably the thing that people are most unaware of.
Got it. Well, Lindsay, this has been super insightful. I appreciate your time. And,
of course.
And I'm sure that it'll be watched by many people.
Hopefully.
So where can they find you?
I am on all of my socials. So Facebook, Instagram, TikTok even. I have a website. My website is lindsayodell.com. My Facebook, I believe it's Cherry Creek Guild Mortgage, Lindsay O'Dell, something like that. And yeah, all of my socials and everything are linked on my website. So if you can find my website, you can find the socials and all that, or my cell phone. I'm always free to take phone calls or text messages. So yeah.
Got it.
Anyway, I'm reachable through various different avenues.
Excellent. Well, thank you very much.
Thank you.
Appreciate it.
Of course.